Last week, someone asked me, should I invest in index funds or try to pick individual stocks? And I realized they were asking the wrong question entirely. It's like asking, should I drive to Los Angeles or should I fly? Without first asking, wait, do I actually need to go to Los Angeles? Most people jump straight into how to invest without understanding why they're investing, when they should invest, and most importantly, what they're actually trying to accomplish. And this mistake, this fundamental misunderstanding of what investing actually is, costs people hundreds of thousands of dollars over their lifetimes. Not because they picked the wrong stocks, not because they had bad timing, but because they invested without a strategy, without understanding their own goals, and without knowing the one thing that determines whether your investments will actually make you wealthy or just keep you busy. And if you start investing in 2026 without understanding this, you're going to look back in 10 years and realize you wasted a decade. My name is Zane, and I spend way too much time thinking about the gap between how people invest and how they should invest, and why most people are optimizing for the wrong outcome entirely. If you're someone who's been putting money into the market, but you're not actually sure what you're building toward, if you're investing because you know you're supposed to, but you don't have a clear strategy, make sure to hit that subscribe button right now. And give this video a thumbs up if this helps you out, because what I'm about to explain is the difference between investing with purpose and just throwing money at the market and hoping for the best. Here's the thing. Investing without this one piece of knowledge is like getting in your car and driving without knowing your destination. You might end up somewhere, but it probably won't be where you want it to go. So let me start with the question that most people never ask themselves before they start investing. What are you actually trying to buy with this money? Not what stocks should I buy? Not should I invest in crypto? Not is now a good time to invest? What are you trying to buy? Because here's what most people don't realize. Investing isn't the goal. Investing is the tool. The goal is what you do with the money on the other end. Are you trying to retire at 55 instead of 65? Are you trying to buy a house in 5 years? Are you trying to build enough wealth that you can take a year off to travel? Are you trying to generate passive income so you don't have to work at all? These are completely different goals, and they require completely different investment strategies. But most people skip this step. They just open a brokerage account, dump money into an S&P 500 index fund, and hope that 30 years from now it all works out. And look, index funds are great. I have most of my money in index funds. But invest in index funds isn't a strategy, it's a tactic. And tactics without strategy is just hoping. Let me give you a concrete example. Person A is 28 years old, Ed. They're investing because they want to retire early, maybe at 50 instead of 65. They need their money to grow aggressively. They've got 22 years, so they can handle volatility. Their strategy should be growth-focused, high equity, minimal bonds, and they should be maximizing tax-advantaged accounts first. Person B is also 28 years old, but they're investing because they want to buy a house in 3 years. They need a down payment of $60,000. Their money needs to be accessible and relatively safe. Their strategy should be conservative. High yield savings, maybe some short-term bonds, definitely not 100% stocks. Because if the market drops 20% right before they need the money, they're screwed. Same age, same income, completely different strategies. And if person B invests like person A, they might have to delay buying a house for 2 years waiting for the market to recover from a downturn. This is what I mean when I say most people are investing without knowing what they're trying to buy. The time horizon trap. Here's where it gets really interesting. The single most important factor in how you should invest isn't your risk tolerance. It's not your income. It's not whether you're smart or dumb about money. It's your time horizon. Time horizon is when you're going to need the money. And if you get this wrong, you're going to either take on way too much risk or leave massive amounts of growth on the table. Let me break this down with real math. If you have a 30-year time horizon, meaning you won't need this money for 30 years, you can afford to be in 90 or 100% stocks. Why? Because over any 30-year period in market history, stocks have always been positive. Always. Even if you invested the day before the Great Depression, the 2008 crash, or any other disaster, if you held for 30 years, you made money. But if you have a 3-year time horizon, stocks are a gamble. Because over 3 years, the market could be down 30%. And if you need that money in 3 years, you don't have time to wait for recovery. Here's the math that nobody shows you. $10,000 invested in the S&P 500 over 30 years, averaging 10% annual returns, $174,494. But that same $10,000 could be worth $7,000 or $13,000 at any point in those 30 years, depending on market timing. If you need the money in year 3 and the market is down 30%, you've got $7,000. If you can wait until year 30, you've got $174,494. Same investment, same person, The only difference is when you need the money. And this is the trap most people fall into. They invest money they're going to need in 3 years in assets that are designed for 30-year time horizons. Or vice versa. They keep money they won't need for 30 years in a savings account earning 1%. Both are catastrophically wrong. The inflation factor. Now you might be thinking, okay, Zane, but I'm just trying to save money. Why do I need to invest at all? Why can't I just keep it in a savings account? And this is the part that frustrates me the most. Because the answer is simple. Inflation is stealing from you every single day. Let me show you what I mean. Let's say you save $50,000 in a savings account. You're responsible. You're building wealth. You've got money for emergencies and future goals. Your savings account pays 0.5% interest. That's $250 per year. But inflation is running at 3% per year. That means the purchasing power of your $50,000 is decreasing by $500 per year. You're earning $250 and losing $2,500. Net loss, $250 per year. Over 10 years, you've saved $50,000, but its purchasing power is now equivalent to $38,609 in today's dollars. You lost $11,391 by doing nothing. That's not saving money. That's slowly going broke in a way that feels safe. Now let's say instead you invested that $50,000 in a diversified portfolio, averaging 7% annual returns after inflation. After 10 years, 98,350 You doubled your money in real terms. The difference between saving and investing, 59. So you sit in 140 hours. And this is what most people don't realize. Not investing isn't the safe choice. It's the guaranteed way to lose wealth over time. But here's the key. This only works if you don't need the money in the short term. If you need it in 2 years, inflation is still a problem, but market volatility is a bigger one. This is why time horizon matters so much. The sequence of returns, risk. Here's the thing that almost nobody talks about, and it's going to change how you think about investing forever. The order in which you get your returns matters just as much as the average return. This is called sequence of returns risk. Let me show you why this is so important. 2 investors. Both invest $10,000 per year for 10 years. Both average 8% annual returns. But they get those returns in different orders. Investor A gets great returns in the first 5 years, then mediocre returns in the last 5 years. Investor B gets mediocre returns in the first 5 years, then great returns in the last 5 years. You'd think they'd end up with the same amount, right? Same contributions, same average return. Wrong. Investor A ends up with significantly more money because their early contributions had more time to compound at high rates. And here's where this becomes critical. When you're starting to invest, the sequence matters most when you're close to needing the money. If you're investing for retirement and the market crashes the year before you retire, you've got a serious problem. You don't have time to recover. But if the market crashes in year 2 of a 30-year investment plan, it's actually good for you because you're buying stocks on sale for the next 28 years. This is why your strategy needs to change as you get closer to your goal. Early on, volatility is fine. Near the end, you need stability. Most people don't adjust. They invest the same way at 28 as they do at 58, and it costs them. The tax efficiency trap. Here's another thing that nobody tells you. Where you invest matters almost as much as what you invest in. I'm talking about tax-advantaged accounts versus taxable accounts. And the difference over a lifetime is hundreds of thousands of dollars. Let me break this down. You've got 3 main account types. Traditional 401k, or IRA. Money goes in pre-tax, grows tax-free, taxed when you withdraw in retirement. Roth 401k, or Roth IRA. Money goes in after tax, grows tax-free, withdrawn tax-free in retirement. Taxable brokerage account. Money goes in after tax. You pay capital gains tax on growth when you sell. Most people just dump money wherever without thinking about tax efficiency. But here's the math that matters. $10,000 invested in a taxable account, growing at 10% for 30 years, $494, but you owe capital gains tax on the $494 in gains. At 15%, that's $24,674 in taxes. You keep $149,120. That same $10,000 in a Roth IRA, growing at 10% for 30 years, $174,494. Tax owed, $0. You keep all $174,494. The difference, $24,674 from the same investment, same return, just different account. Now multiply that across every dollar you invest for your entire working life. The tax efficiency difference is often $200,000 to $500,000. And here's the thing, you can't fix this later. Once you've paid unnecessary taxes, that money's gone. You can't go back and undo it. This is why understanding account types before you start investing is so critical. The behavior gap. Now here's the part that's going to make you uncomfortable. Because it's not about strategy, it's about psychology. The biggest factor determining your investment success isn't the market. It's you, your behavior, your emotions, your ability to not panic and do something stupid. There's research from Dalbar that shows the average investor underperforms the market by about 4% per year. Not because they pick bad investments, but because they buy high and sell low based on emotions. The market drops 15%, they panic and sell. The market rallies 20%, they FOMO back in at the top. Over 30 years, a 4% behavioral gap turns into a catastrophic wealth difference. $10,000 per year invested at the market return of 10%, 189,434 after 30 years. That same $10,000 per year invested at 6%, market return minus the 4% behavior gap, $838,019 after 30 years. The behavior gap cost this person $971,115, almost $1 million lost because they couldn't control their emotions. And this is why knowing what you're investing for matters so much. If you don't have a clear goal, you'll be tempted to tinker. You'll be tempted to panic sell. You'll be tempted to chase the hot investment. But if you know exactly what you're building toward, I need $80,000 for a down payment in 2029, or I'm building wealth to retire at 55 in 2050, you can ignore the noise and stick to the plan. The actual strategy. Okay, so here's how you actually do this. Here's the framework. Step 1, define your goal with brutal specificity. Not, I want to invest, not, I want to be rich. I need $50,000 for a house down payment by December 2029. Or, I'm building $2 million in retirement savings to retire at 55 with $80,000 per year in income. Write it down. Be specific about the amount and the date. Step 2, calculate your time horizon. How many years until you need the money? This determines everything about how you should invest. Under 3 years, conservative. High yield savings, short-term bonds, minimal stocks. 3 to 10 years, moderate. Mix of stocks and bonds, maybe 60-40. Over 10 years, growth-focused, heavy stocks, minimal bonds. Step 3, choose the right account type. For long-term goals, retirement, max out tax-advantaged accounts first. 401k, Roth IRA, HSA. For medium-term goals, house car sabbatical, taxable brokerage, or high-yield savings depending on time horizon. Never put short-term money in retirement accounts. You'll pay penalties to access it. Step 4, automate the contributions. Manual investing fails because you'll skip months, second-guess yourself, or spend the money on something else. Automate it. Set it and forget it. You can't panic sell if you're not constantly looking at it. Step 5, ignore the noise and stick to the plan. The market will drop. It will rally. You will be tempted to do something. Don't. If your goal and time horizon haven't changed, your strategy shouldn't change. The biggest returns come from doing nothing when everyone else is panicking. Look, investing isn't complicated, but it requires clarity. If you invest in 2026 without knowing exactly what you're trying to accomplish, how long you have to get there, and which accounts to use, you're going to waste years or lose tens of thousands to taxes and bad decisions. But if you take the time now to define your goal, match your strategy to your time horizon, and automate the process, you'll be in the top 10% of investors just by having a plan. Most people don't fail at investing because they picked the wrong stocks. They fail because they never defined success. They never knew what they were building toward. So they drifted, made emotional decisions, and wasted years doing the wrong thing consistently. Don't be that person. Define the goal, match the strategy, automate it, then let time and compounding do the work. If this gave you clarity on what you need to do before investing in 2026, hit that subscribe button. I break down the strategies and mindset shifts that actually build wealth every single week. Thanks for watching. Now go define your goal and build the plan.